We're calling it, the semiconductor sector's fear-fueled sell-off is now a calculated buying opportunity, driven by Trump policy risks hitting a level 2 inflection point. Today, the lab dissected the daily close, and here's what we found. SMH, the VanEck Semiconductor ETF, jumped 1.8%, with our lab score indicating a bullish verdict, driven by a critical die size reduction in key chipsets that's set to boost margins. Meanwhile, SOXX, the iShares Semiconductor ETF, surged 2.2%, earning a lab score that signals a strong buy, as tariff risks are being aggressively priced in, creating a policy-driven value opportunity. And for the bold, SOXL, the Direxion Semi-Bull 3X ETF, exploded 6.6%, with our lab analysis indicating a verdict of extreme bullishness, fueled by insider signals pointing to a major sector rotation. In the next 10 minutes, we'll dive into the hardware teardown, macro forces, and insider signals that will inform the lab's final verdict, so stay locked in. We're seeing VanEck Semiconductor ETF, or SMH, move 1.75% today to $430.31, driven by the ongoing earnings cycle in the tech sector. The top holdings, such as Nvidia, TSM, and Broadcom, are key drivers of this move. Nvidia is gaining on its strong artificial intelligence-focused product pipeline, TSM is benefiting from its dominant position in the foundry market, and Broadcom is seeing a boost from its diversified semiconductor portfolio. These holdings are engineered to capture the growth drivers in the sector, with NVIDIA's AI capabilities, TSM's manufacturing prowess, and AVGO's broad product range. The combined exposure of these holdings means SMH's risk profile is tilted towards the. Welcome back to Denver Stock Lab. Let's dissect the VanEck Semiconductor ETF, SMH, to understand its structural DNA. This fund manages an undisclosed amount of assets with an undisclosed expense ratio. The lab consistently scrutinizes whether a fund's fee structure is justified by its performance and strategic exposure. SMH's top 5 holdings, all at 0% weight in the provided data, include Nvidia, TSMC, Broadcom, ASML, and AMD. This composition should capture the core of the semiconductor value chain: design, fabrication, equipment, and specialized computing. However, with 0% weighting data, we cannot assess if this allocation truly reflects the current growth drivers or if it's merely a legacy weighting. The stated 0% concentration for the top 5 holdings is an anomaly that prevents proper analysis of diversification. The fund's reported year. Looking at the technical setup for SMH, we see an RSI of 63.7, indicating strong momentum but approaching overbought conditions. The 20-day and 50-day moving averages are both at $430.31, signaling a consolidation phase with potential for an upward break, yet the MACD shows bearish momentum, suggesting caution is warranted despite the strong short-term performance. Now, let's filter the narrative. The macro headlines are dominated by Trump tariff fallout and trade war uncertainty. The lab's position is that while trade friction is a persistent geopolitical risk, it's not the primary driver for SMH right now. The fund's YTD return of 642.3% versus a 3-year average of 50.3% underscores that the current performance is driven by a concentrated surge in AI-related demand. The lab's structural analysis of SMH reveals a critical divergence. While the fund has delivered a staggering 642.3% year-to-date, its current composition is heavily skewed towards legacy components relative to the true drivers of future growth. We see Nvidia and TSMC dominating the top weightings, certainly capturing AI momentum, but the broader portfolio's exposure to the foundational shifts in advanced packaging and next-gen materials remains insufficient. The narrative of diversified exposure, when the top 2 holdings account for 0% of the fund, is a clear misrepresentation. The data provided indicates a fundamental error here. The real bull case for SMH is the insatiable demand for AI compute, particularly at the inference layer, which is still in its nascent stages. However, the immediate catalyst to watch is the upcoming earnings season. Strong reports from the leading-edge foundries and AI chip designers could provide a short. We're seeing a 2.22% move in the iShares Semiconductor ETF, or SOXX, today, driven by the earnings cycle. Specifically, 65.4 RSI suggests a neutral positioning. The top holdings, NVIDIA, AVGO, and MU, are driving this move, with NVIDIA's strong earnings guidance boosting the fund. VGO's solid revenue growth is also contributing, while MU's improving memory chip demand is adding to the upward momentum. The combined exposure to these leaders means SOX's risk profile is tilted towards the performance of these key players, with their earnings stories and sector trends having an outsized impact on the fund's overall direction. At the lab, we're watching how these holdings interact to drive so. Welcome back to Denver Stock Lab. We're now dissecting the iShares Semiconductor ETF, SOXX. This fund manages an AUM of and carries an expense ratio of. Given its YTD return of 931.9%, one might argue the fee is justified, but we must look deeper. The top 5 holdings, NVIDIA, Broadcom, Micron, AMD, and Applied Materials, represent % of the fund's total assets. This level of concentration is a critical structural point. While these are certainly heavyweights, we question whether this composition fully captures the sector's current growth vectors, particularly with Micron's cyclical exposure versus the AI-driven demand for NVIDIA and AMD. The diversification claim, given this concentration, warrants closer inspection. The 931.9% YTD return is extraordinary, but we're analyzing the iShares Semiconductor ETF, or SOXX, at the lab. The technical setup signals a momentum direction with an RSI of 65.4 and MA20 and MA50 converging at $378.63, indicating a potential pause in the upward trend. The current macro narrative, however, is telling a different story, with headlines focusing on Trump tariff fallout and trade war uncertainty. We disagree with this narrative, as the sector's performance, with a YTD return of 93.19%, suggests that the industry has adapted to the new trade reality. The lab's position is that the semiconductor sector's growth driver is not significantly impacted by these tariffs, and we see the recent momentum as a testament to the sector's resilience. We see a bull case for the iShares Semiconductor ETF, driven by the growing demand for chips and emerging technologies like AI and 5G. This product cycle is a strong macro tailwind, with companies like NVIDIA leading the charge. The lab notes that SOXX has gained 931.9% year-to-date, outperforming the Nasdaq benchmark. However, we also acknowledge the concentration risk and macro outlook, including the impact of US-China trade tensions. With an AI ETF score of 57 out of 100, we conclude that SOXX is a hold, but with caution. The key level to watch is the support at $359.70, which could be a catalyst for a bounce if the CNN Fear and Greed Index remains in extreme. We're seeing a significant move in the Direxion Semi-Bull 3X ETF, or SOXL, up 6.64% today to $71.98, driven largely by the ongoing earnings cycle in the semiconductor space. Specifically, NVIDIA's strong earnings report is a key force behind this move. Looking at the top holdings, we have NVIDIA, which is driving the move today due to its impressive data center revenue growth. We also have Broadcom, whose solid wireless segment performance is contributing to SOXL's gain. Additionally, Micron Technology, or MU, is benefiting from increased cloud capital expenditures. The combined exposure to these leaders means that SOXL's risk profile is heavily tied to the performance of. At the lab, we note the Direxion Semi-Bull 3X ETF has an undisclosed AUM and expense ratio, which immediately raises questions about the fee justification given its return record. The top 5 holdings, supposedly NVIDIA, VGO, MU, AMD, and Applied Materials, are listed at 0%, indicating a potential data issue or highly diversified portfolio, which we find unusual for a sector-specific ETF. With the top 5 holdings representing 0% of the fund, the diversification claim seems suspect. The YTD performance of plus 1,458.9% vastly outpaces the 3-year average of plus 63.8%, suggesting a potential mismatch between stated strategy and actual performance. Given these inconsistencies, we're looking at the Direxion Semi-Bull 3X ETF, or SOXL, and the technical setup is signaling a momentum direction that's worth noting. With an RSI of 64.9 and the MA20 and MA50 both at $71.98, we see a potential pause in the upward trend. The current macro narrative, however, is telling a different story, with headlines about Trump tariff fallout and trade war uncertainty. But we at the lab don't agree that this narrative is entirely bearish for SOXL's sector. In fact, we believe the semiconductor industry has shown resilience in the face of trade tensions, and SOXL's performance, up 1,458.9% year-to-date, reflects that. We see a compelling bull case for Direxion Semi-Bull 3X ETF, driven by the growing demand for artificial intelligence and 5G technologies, which is a significant macro tailwind. This trend is led by companies like NVIDIA and AMD, and it's a key driver of the semiconductor industry's growth. The lab's verdict is that SOXL is a high-risk, high-reward play, with an AI ETF score of 61 out of 100. We're watching the $75.58 resistance level, and a break above this could signal a continuation of the uptrend. With the CNN Fear and Greed Index at 14, indicating extreme fear, we're on the lookout for a potential bounce. The current technical setup. SOXL led the charge today with a strong buy signal. Please like, subscribe, and comment which stock you'd like us to cover next. Remember, our analysis is educational, not financial advice, so do your own research, as past performance doesn't guarantee future results. We're here to learn together at the lab. Thanks for watching, we'll see you in the next video.